morning and welcome. Patriot Radio News Hour, Joe and Jason on this Tuesday. And already a lot of fireworks happening. This is to be expected. You know, we've been talking about the calm, right? We're in that choppy seas. We're in that calm area. The calm coming to an end. Major downgrades of U.S. banks today. The list is big. It is from small banks to mid-sized banks, the largest banks. Well, we'll get it all to you and so much more today. Our toll-free number, 800-951-0592. The website at allamericangold.com. And now more than ever, you know, it looks like the calm of the summer has passed us. This was going to be a tough week already. The Treasury was going to start with all of these supersized auctions and how much debt could we sell. The yield steepening continues as the taxpayer now having to flip the bill for all the borrowing rates from 3 months, 6 months, 1 year, 2 year notes continuing to march higher. The 10-year note, you know, hovering in that 4% range, but for how long? And then Moody's, Jason, this morning dropped a bombshell on U.S. banks. We told you this wasn't over. We told you. And the reason why it wasn't, it's just math. It's all it is. It's not complicated. It's not real hard. We've got major deposits leaving banks, Jason. It hasn't ended. Now, it may not be where it was 6 months ago, but the amount of deposits, and it's every size bank, small size banks, medium size banks, the largest banks, believe it or not, well, I guess it's, you know, they got most of the money. So it stands to reason they've lost more deposits than anybody, Jason. But now, when you really start to take a look, okay, you got three buckets, banks, right? Because we know the banks don't have any money. They don't. Right? They operate with just enough to handle, you know, you go into the ATM and withdrawing, you know, $40. They handle your debit card payment at In-N-Out Burger, right? They handle you buying your groceries over at Walmart, paying your mortgage, all that stuff. They handle it, but that's all they got. And most of the time, they got to sell one of their three buckets. Now, for those of you that are new, you're like, what is he talking about, three buckets? Well, by law, banks have to buy certain things. And what does that mean? Well, when deposits go in, they lend out, 94% of it. They can't lend it all out, as an example. They can't do all the lending in housing. That's not allowed. Right? Nope. They've got to, hey, you've got to do a certain amount and what they call mortgage-backed securities. Right? That's your commercial, your residential. A certain amount in U.S. Treasuries. Right? One of the reasons you're like, well, gosh, how can everyone be buying all this debt? Foreigners, they only own $7 trillion. Well, now you know, because the banks by law have to buy treasuries. And then the last bucket, which is the smallest bucket, is stuff the banks can do on their own. Right? Hey, they may say, hey, you know what, Joe and Jason, I like you two guys. Right? You guys are good risk. We're going to give Patriot Trading Group a $250,000 line of credit. Or we're going to give that guy, hey, we're going to loan this guy some money to buy a new car or a new work truck, whatever, that kind of stuff. Well, when it comes time every day to pay all the bills, right, okay, here's all the stuff that came in. Right? Here's all the people that withdrew money out of the ATM. Here's all the people that used their debit cards. Here's all the people that used their credit cards, right? All the payments, the online payments, the auto pays. Right here, how many car loans, insurance, mortgages. And whatever they're short, they've got to sell one of those three buckets. Well, guess what? Moody's started to look at those three buckets. And here's what they realized. We got a problem. And you know what Moody's did? They said, we've got a problem no matter what size bank it is, Jason. They just didn't say we got a problem with small banks or regional banks. Nope. They said, hey, we got a problem no matter the size of the bank.
I mean, yeah, last year the Fed identified 700 and plus banks that were had bad assets that could sink them on their balance sheets. So I mean, to me, these are the ones that are first in line for failure, Joe. That's what you're talking about. I think there's way more banks than that they're saying. They identified, this is after quarter 3 of 22, they identified 700 and I think it was 22 banks that looked like they were going to be insolvent with what they were holding. So they know what's going on, Joe. And it's, I guess March we had a few banks fall down, and now there's a few more that are being swallowed up. And I think I think they're going to try to trickle the faucet in just a few banks at a time. But what usually ends up happening is the domino effect. Suddenly 3 banks turns into 9, and 9 turns into 27, and it just spirals out of control, Joe.
I hope you're wrong. I want it to be like it's been, right? A bank here, a couple banks there. Man, we don't want to see weekends where they're coming out and saying, hey, we had 10, 12, 20 banks going under. We definitely don't want something like that. When we get back, we're going to name names. We'll tell you who it is that Moody's said, hey, you're on the list. Pick the Radio News Hour. Don't touch that dial. (800-951-0592). Joe and Jason on this Tuesday. A quick look here. The Dow's down 400 points. Get ready. Volatility coming back. You know, we had 4 straight down days in a row. Yesterday, a big rally. Today, a big wipe out. The S&P down 50. The NASDAQ down over 200 points. Gold's off 5. But really kind of boring today, which is probably a good thing. Silver, buy all you can. That's all I'm just telling you. Buy all you can right now. Silver down 30. We've been warning you. 30 cents, by the way, not $30. That would be, well, silver's not even $30. So obviously 30 cents right now. But we've been warning you about having this money in the bank. How much more proof do you need? How much longer are you going to sit there and do nothing? Well, I know. Well, I'm just going to hope it goes away. I'm going to hope it doesn't happen. I mean, well, look, you know what? Joe thought it was already going to happen last month. It didn't happen last month, so maybe it won't happen at all. It's happening. How much longer are you going to sit there and do nothing? Are you going to take another ass-kicking like you took in 07 and 08, like you took last year and still do nothing? Check out our friends at Y-Refi, up to 10.25% returns. It's fixed. It doesn't care. Listen, you can downgrade all the banks you want. They don't care. You can raise rates, lower rates. They don't care. Oil can be 100. It can be 70. They don't care. You don't have to worry what's the stock market going to do tomorrow? Is my bank going to be open tomorrow? Check them out. InvestYRefi.com. That's the word invest, the letter Y, REFY.com. Or call them at 888-YREFI24. And as you know, you need a minimum of $50,000. But you can use an existing IRA. Some of you can use a 401k. But check them out, YRefi.com. But, Jason, it's all about the banks. And again, they've been trying to tell you, oh, don't worry, it's over. It's over. Well, the first wave was over, which seemingly came out of nowhere, right? We'll call that the rogue wave, right? Because nobody saw it coming. But this wave, everybody who actually knows I'm not talking about the people that want to lie to you on TV. Okay? I'm not talking about the cheerleaders out there. Okay? It's time for you to put your big boy pants on. Take care of yourself. They're not looking out for you. Right? This is why we have like Joey. Why do I have Joey on here every single week? There's a reason. You know why? Because Northwestern Mutual, they're not a bank. They're not publicly traded, and he'll look out for you. Why refi? They're not tied to any of that crap. They'll look out for you. Patriot Trade. You know, when you got gold and silver, you're looked out for, period. Because you're looking out for yourself. You know exactly where your gold and silver is. You know exactly where it is. You have the ultimate control. And when we sit here and we live in fantasy land, that somehow we can just spend trillions. And somehow, miraculously, inflation's just going to go away. No, it's not. Well, it will. I've already told you how. When tens of millions of people lose their job, the inflation will go away. Plain and simple. I don't know if you saw gas prices this morning in Arizona. Yeah, 20 cents. One day. Get ready. But Moody's today came out and said, listen, there's three main factors in the announcement today. First, higher funding costs. Well, how does that happen? Well, rates go higher, right? Cost more, right? Oh, wait, we got to pay our employees more, right? And all this stuff. We got all this other inflation, all this stuff. By the way, I'll show you here. If for all you people on YouTube, you can see my letter. I'm holding this letter up from my bank. You know what it says? We're going to charge you more. Yep. Credit card fees going up again, right? We're going to get charged more for everything. Get ready. But Moody's, higher funding costs. Regulatory capital weakness. That's what we explained in the last segment. In other words, they're saying banks got a problem on the stuff that the Federal Reserve makes them buy. Right? What are we talking about? Treasuries. What are we talking about? Commercial mortgage-backed securities. And not just commercial, it's mortgage-backed securities. Why? Well, remember what I told you. Today, I don't have enough money today. Because today was a big day for my bank. A lot of people made their mortgage payment today. A lot of people made their health insurance payment today. A lot of people made their car insurance and their car payments today. I'm a little short today. So I got to go and sell from one of my three buckets. Well, we can sell treasuries. Well, guess what? Rates keep going higher. That's a loser. Right? So, we had to sell $1 billion in treasuries. Well, and actually, in order to get the $1 billion, we had to sell $1,100,000,000. We lost $100 million because, the Fed keeps raising rates. Well, I know. Wait a minute. Let's sell the mortgage-backed stuff. Oh crap! Man, that's even worse, right? I sell $1 billion of that. I gotta sell 1.3 billion to get $1 billion, right? I lose 300 million there because the commercial real estate's a mess. Well, what about one of your other buckets? Well, according to Moody's, weakening demand and weakening, credit factors across the board. Moody's lowered the credit agencies on almost a dozen small banks, a dozen mid-sized banks, and then put, it's kind of incredible, half a dozen big banks on notice, and then said, by the way, reviews on hundreds of more banks coming in the future collectively. These three developments have lowered the credit profile on numerous U.S. banks, though not all banks equally, right? So what banks cannot be equal? There's only one way. Our third bucket, the ones that we're doing ourselves, that little sliver, that one's holding in there for us. We've done a better job, right? And that's just probably really, we don't really loan in commercial real estate. That's probably it. That's probably the exception, right? Other than that, I don't know that other areas are performing very well. By the way, credit card debt for the very first time ever is now over $1 trillion and continues to rise. The consumer, this is a big problem, right? Big problem for the banks. They said that the firms, okay, so here we go. They cut the rating. Now, these ones, they actually cut them. M&T Bank, right? These are the mid-size. Webster Financial, BOK Financial, Old National Bank Corp, Pinnacle Financial, and Fulton Financial. Then they said that they put Northern Trust and Cullen Frost banks on what they call review for downgrade. So those banks there, these are all what we would call mid-size banks. These are, M&T, BOK, these are some fairly good-sized banks. They've also developed a negative outlook. I love how they developed it. For another 11 lenders, including PNC Financial. Boy, PNC, they're kind of almost a big bank, right? Capital One, what's in your wallet? Yeah, they're a bank. Yeah, I know. But aren't they a credit card company? Yeah, they got trouble. Citizen Financial, Fifth Third Bank Corp, Ally Financial, Huntington Bank Shares, and Bank OZK. Jason, this is essentially really, when I'm looking at this, the vast majority of mid-sized banks pretty much got downgraded or got told you're getting ready to get downgraded.
That's correct, Joe. I just when you look at all the factors working against banks, how can you have? And how many banks are there left? There's about 4,000 banks, Joe. Is that where we're sitting at? How can under the circumstances of the last few years leading up to 2023, how can there not be, I would say, dozens and dozens more banks, way more stressed than just the ones that Moody's identified, Joe? So, these guys, this system that's set up, they don't like rocky waters. They don't like to say things that rock the boat, right? They want to keep things very calm and very professional and very, they want the markets just to always do good. So by just simply having a list, Joe, that they put out there means that there's a lot of problems coming, because if they're putting banks on a list, these banks must really be in trouble, Joe, really, really bad, which means the next level of banks that would probably be on Moody's list are probably just really bad. The ones that are on the list are really, really bad. This is stuff that's going to change everything about the economy in the coming weeks and months, Joe. It's going to get really, really bad. It's just, we talked about it before the show, it's like one step at a time. There's always one more bad indication of where we're headed. Every single day, it's one thing at a time. We're just kind of waiting for that day where like 10 things happen all in one day. That's what we're waiting for, Joe. And then that's when the panic starts.
And again, this is just one of the first waves here. Despite Wall Street's best efforts to restore confidence, Moody's warned that banks have substantial unrealized losses. Remember, they're not a loss until they have to sell them.
Yep.
Right? Hey, I'm holding the debt, whether it's a treasury, a mortgage-backed security, whatever it may be. Somebody's paying on it, maybe, right? Because commercial real estate, probably not. But it's not a loss until they have to sell it. And because deposits have collapsed, the selling is coming. And Moody's said they are not captured by their regulatory capital ratios. In other words, if you're out there doing your homework on your own bank, You're not going to find it on their financials. Because Moody's says, hey, they don't have to put them in there. They should, right? They should say, hey, by the way, we have this many assets, and oh, by the way, if we actually had to sell these assets, here's what they would actually be worth. Right? We have assets of $100 billion. But if we had to sell it, right, hey, they're only worth $90 billion. Well, that's a problem, right? That's a $10 billion loss, right? That's a problem.
Well, that's what the Fed identified last year, Joe. The Fed identified after quarter three, those 722 banks had 50% or more of unrealized losses. That's what they identified last year. That was exactly what they identified. It's coming.
And listen to what they said next. This may be the most important sentence. Yes, you can't see it on their regulatory capital ratios, but these banks are susceptible to sudden losses of market or consumer confidence, especially in this high rate environment. In other words, right, another rogue wave is coming. I'll give you more banks when we get back. Eight 800-951-0592, Patriot Radio News Hour here on this Tuesday. I guess we'll call it Downgrade Tuesday as Moody's has dropped the hammer on the banks here. Rising funding costs, declining income metrics. Okay, so what does that tell you? Hey, not only are big depositors leaving, the depositors that aren't leaving, their balances are going down. They're running out of money. Right? Think about that. Right? That's one you don't think about. Right? Everyone understands. Man, I had a hedge fund in my bank, and he had a $500 million of cash sitting in the bank, and he left. Well, that's a problem. But I've got $500 million of little depositors. And all of a sudden, first it was 475, then it went to 450, then it went to 4. Now we're down to 320 million. That's a problem. And this is exactly what Moody's is saying. They said asset risk is rising, in particular for small and mid-sized banks with large exposure to commercial real estate. And Jason, here's the problem. That's usually the specialty of small and mid-sized banks. And Moody's is pretty much saying, when you think about, we've got, over 4,000 banks. Now, some of them really aren't banks, right? Like Ally Financial and Capital One. We called them banks. But the vast majority, I'm talking about of the 4,500, 4,300 fit into this category of small to mid-size, and most of them, not all of them, but most of them specializing in commercial real estate. But then they weren't done. If that wasn't enough, U.S. banks continue to contend with interest rates and asset liability management risk, with implications for liquidity and capital as the wind down of unconventional monetary policy drains system-wide deposits. Oh, what are they talking about? Jason, you think that's the reverse repos that we've been warning everybody about? You think that's what Moody's was just talking about, saying, hey, this thing's going to get a lot worse because the banks are quickly running out of money, and then you think interest rates are bad now. Wait till that happens.
Yeah, it's like a fuse that's lit when that account, the reverse repo account, start to empty out. Once that gets to zero, then that means, well, who's going to give us the cash? Where do we get more cash, Joe? So I think that was set up for big institutions to place a lot of money there, because you can't just be anybody to put money in the reverse repo. You have to qualify, And when that's emptying out, that means middle or upper middle and large institutions are pulling cash. So you better believe what you're talking about with these smaller and mid-sized banks. They're probably hurting. They're hurting for it because where do they borrow their money, Joe?
Where do they borrow the money?
Somebody up the chain. Up the chain.
Meanwhile, many banks, and really most of the banks, their Q2 results, second quarter results, showed growing profitability pressures that will reduce their ability to generate internal capital. So in other words, expenses for the banks are up, deposits are down. They're going to be very restricted. That third piece, that one piece where they can maybe offset, Moody's is saying that piece is getting smaller. That piece is getting smaller. It's going to be harder. And Moody's says this is because we're still at a mild recession in 2024. And to Jason's point, they upgrade that to just a regular recession, right? You're going to see hundreds and hundreds of more banks on the list. But Moody's wasn't done. Oh, no. They weren't done. They also said, hey, by the way, there's other banks that have problems. Ready for this? How about this bank? The Bank of New York Mellon. Ooh, right? That's kind of the Wall Streeter bank. State Street Bank, right? One of our big three, right? They're into everything. Truist Financial. And then U.S. Bank Corp made the list. So, Jason, this was something. Now, these banks didn't get downgraded. Moody's just said, hey, we're putting you on what they would call negative review, Jason.
For State Street to be on there, it's going to be one of two things, and that's commercial real estate, if they're heavy in that. Or maybe someone's looking at stocks as not being a safe place now.
And huge deposits, right? State Street
yes.
Probably is susceptible to, we've got, 100 high net worth hedge fund deposits, and if
right.
These guys run and cover, we got a problem.
Correct. Exactly. So it's creeping up the food chain, Joe. Every day. So we'll watch this because one of these big players falls, Joe. We know what happened when Lehman Brothers fell. That was a disaster.
Yeah, and again,
that's what we will look for.
I hope not. This is an eye opener. I don't remember seeing, because you got Moody's, you got S&P, you got Fitch, right? Fitch downgrades America, right? Downgraded the U.S. Treasuries to AA+, downgraded Fannie and Freddie as well. And then then Moody's comes out and just says, hey, here's dozens of banks, and not just dozens of banks, but then they said hundreds more are coming, right? The potential, all of it to the downside when it comes to banks. You better be ready. Listen, we have rolls of silver quarters, right? We started this sale yesterday. $200 a roll for 40 silver quarters. You buy 25 rolls or more. 25 rolls is a quarter bag. You can buy 50 rolls. That's a half bag. You buy 100 rolls. That's a full bag. We'll take it down to $195. And then on the gold side, huge special today on the 1/10 ounce American Gold Eagle. So this is a fractional day. You get barterable material when you got the silver quarters, and now the 10th ounce American Gold Eagle, 1 through 49 at $250, 50 or more at $245. And as all of you know, we're cheaper than all the big internet guys. 800-951-0592. Jason and I, we're coming right back. $800-951-0592. Joe and Jason, Patriot Radio News Hour here on this Tuesday. I mean, here's the sad part. We already know the rating agencies are so far behind. Right? By the time they tell you that it's a problem, it's already too late. I would just say a lot of pain is coming to those banks that got downgraded today, because chances are that downgrade should have happened a long time ago. We all know that. You cannot sit here and wait and hope it doesn't happen. It's happening whether you want it to happen or not. None of us want it to happen. But this is why I said we need to get rid of the Federal Reserve. We need to go back to sound money. You don't have these problems when you do things like this. You got to break these banks up. They're way too big. They have way too much risk. We know this. But again, that would give them less control, and that's really what this is all about. That's why when you buy gold and silver, you're out of the system. You're taking a certain percentage of your money and saying, I'm out. Right? I'm taking it out. Right? I got a 401k. I got an IRA. They're in. I'm going to take stuff and I'm going to have it outside of, because we know what does well when the money in the system isn't doing so well. It's the money outside. And that's where gold and silver come in. Rolls of silver quarters, 40 silver quarters, $10 face value, $200 a roll. You buy 25 rolls or more, $195. And then the 10th ounce American Gold Eagle, 1 through 49, $250. That's a $10 savings. You buy a roll or more, 50 of them, 50 golden dimes in a roll, $245. We were already the cheapest at $260. Now we're going to get cheaper. 1 through 49, $250, 50 or more, $245 at 800-951-0592. Michael Snyder, he's a guy. Jason, we like him a lot. He puts out some good stuff. You know what I like about him, Jason? He likes to put out lists. Right? Let me tell you. Yeah. Here's what I think's coming, and then let me give you the reasons. Right? Today, the 7 trends that indicate economic disaster is approaching. And in his words, rapidly, very rapidly. That's really the debate, right? First on the list, tax revenues. Well, the government's not talking about it, but it is way down. I mean, we're talking about tax receipts down 10% plus year over year. And we haven't, we're not even in the bad stuff yet. Right? That's always one of the things you look at, because that's really, because Wall Street will say, oh, they beat earnings today. We don't even know what does that mean. Most people think, oh, they're doing even better this year than last year. That's not the case. Hey, we just beat the number. The realities are our business is actually worse than last year, but we beat earnings today because, well, the number was lower than last year, right, Jason? That's how they fake people out.
And did the government, the IRS, know that low tax revenue was coming? And this is why they started proactively a year plus ago, hire 87,000 more IRS agents. So because if you can scrape the peanut butter jar a little harder if you throw some more agents in there, right? So
right, the squeeze is definitely coming. When the economy slows down, trucking companies see less demand. Now that's across the board. Obviously, Yellow Freight, they didn't file bankruptcy. Well, they did, but it's a little different. They didn't file for a reorganization. No, they just flat out, we're out of it. Liquidation. We're out of business. That really gives you an indication of where the whole thing spends. They said spending on shipments down 11%, shipment volume down 9%. Right, so you're seeing the effects here. Employment is supposed to be the bright spot for the economy. But the latest jobs number showed a loss of 585,000 full-time employees. I've got an update for that. The birth-death model. So the government said we created 187,000 jobs. The birth-death model created 385,000. So in other words, what the government really said is we lost 98,000 jobs, but we think somehow 300 and blah, blah, blah people got employed, right? These are birth, death. I call them fake jobs, but this is a new trend. This is the first time that when you factor birth, death in, the number was negative and pretty significantly. It's only 1 month, but it's a sign. U.S. employers announcing job cuts. Man, we know that, right? We know that, right? Job cuts. What is it? Chandler Gray and Christmas, layoff announcements are up 400% year over year. I mean, that's a pretty obvious one. Thanks to rapidly high rising interest rates, mortgage costs for home buying 20% higher than a year ago. So the mortgage payment 20% higher than a year ago. That's not a good sign. Delinquency rates for commercial real estate. We've all been all over that. And last but not least, the U.S. population that can afford a $400 expense fell 2 more percentage points. So, Jason, there's the list from Michael Snyder telling you, here's all the warning signs. Now the question is, what are you going to do about it? Jason and I will be back after the break. $800-951-0592. Credit card balances up 16% in the second quarter. Over $1 trillion. Defaults now starting to pile up. Goldman Sachs just warned $1.8 trillion wall of corporate debt coming. Jobs are going to be lost. And last but not least, Jason, both Lowe's and Home Depot downgraded today before their earnings announcement comes out. So it looks like the tide here is starting to pick up in the wrong direction.
Yeah, there's been a lot less spending going on, Joe. We've been witnessing this since, I think, 2022. I saw a slowdown in spending just with our business. But looking around, there's been less spending going on since then. And this year, here we are in the summer of 2023, at just an extremely lower level of spending. People are out of money. They're just out of money. And on top of that, I think they're running out of credit room to just charge it. That's always the second step, right, Joe? Just charge it. And we had record levels of credit card debt. And there's only so much the credit card companies are going to allow you to borrow before they start to feel uncomfortable themselves, Joe, because they have to protect their business too.
Yeah, I think that's probably the more alarming thing because there's only one reason credit card balances go up. They don't have enough money. It's just that simple. And things are now taking a precarious turn as Moody's kind of pulling the Band-Aid off and saying, man, these unrealized losses are coming home to roost. And then Goldman piled on. They're calling it a $1.8 trillion wall. How big are the losses going to be? That's an incredible amount of debt that needs to be rolled over in commercial real estate that just isn't worth it. I mean, let's just call it what it is. That is big problems ahead. Rolls of quarters, 40 silver quarters, $200 a roll. 25 rolls or more, $195. And then the 10th ounce American Gold Eagle, 1 through 49 at $250. Buy 50 or more, $245 at 800-951-0592. And Jason, as we watch all of this play out, office delinquencies, this is probably what Goldman was warning about. Office delinquencies jumping off the charts. July was a horrible month for people not paying for their office space. And according to TREP, who tracks all of this, The number is expected to approach where we were at the height of the financial crisis. The difference was during the financial crisis, it took like 5 years to get there. Trepp is saying it could get there in a year. We went from less than 2% to over 5% in 6 months. And Trepp is saying we could be at that 10% number before the end of the year. And that was the height of the financial crisis, and that number didn't happen until like 2012.
Yeah, in the getting there as rapidly is much more severe. I mean, if it gets there over the course of years, there's some reaction time. But yeah, 1 year, a lot of people don't see this stuff within 1 year's time, and they miss it, Joe. And that's, once again, pain and suffering coming to those that are not paying attention.
Yeah, and it's just, and again, these are all interest-only balloon payments, and they're all coming due. 800-951-0592. Take the time. Don't wait. Don't wait around. Don't put your head in the sand. Take action. Jason and I, we're coming right back with the Half Empty Cup.